Welcome to this introduction to liquidity ratios. In this section, we'll focus on what liquidity really means, why it matters for day-to-day survival, and who relies on these numbers most. The key idea is simple. A business can look profitable on paper, but still struggle if it cannot pay its short-term obligations when they come due. The current ratio is the broadest liquidity measure because it compares all current assets with all current liabilities. In other words, it asks how much short-term resource a company has for every dollar of short-term debt. As the gauge shows, a ratio above 1 is usually acceptable, while a very high number can also hint at inefficiency. The quick ratio, also called the acid test, is a stricter version of liquidity. It removes inventory from the equation because inventory may not be easy to sell quickly, especially under pressure. The chart highlights the gap between the current ratio and the quick ratio, showing whether a company is relying too heavily on inventory to stay afloat. The cash ratio is the most conservative liquidity test. It looks only at cash equivalents, and marketable securities against current liabilities. So it answers the toughest question. How much debt could be covered immediately with money already in hand? As the visual suggests, this measure is often low, but it becomes especially important in times of financial stress. Operating cash flow ratio takes the analysis beyond the balance sheet and into actual business performance. Instead of a static snapshot, it measures whether day-to-day operations are generating enough cash to cover short-term debts. That's why this ratio is so useful. It shows the real engine of liquidity, not just the appearance of it. Context matters when interpreting liquidity ratios. Different industries naturally operate with different norms, as the benchmark chart shows for retail, airlines, and asset management. The trend line below also reminds us that even a company with a decent starting point can become risky if the ratio declines over time.